Very good afternoon to all of you. We are back again with our session regarding our course, that is Management Control System, which has been coded as MMPL 003. In the block 1, we saw the introductory part of the Management Control System. There we tried to look at what is MCS, that is the Management Control System. We also looked at what is the need for that or the reason behind it. Apart from that, we saw how it helps an organization or its advantages, as well as what kind of limitations it poses on the organization, and what is the general management control system that can be applied to various type of organizations. Now in block 2, starting from your unit 4 and 5 that we have seen, we look at the management control structure. Now when we are talking of the control structure, there we talk of in the first unit under this block 2, that is the responsibility centers. Now when we saw responsibility centers, what is a responsibility center? Now it is a particular unit or segment or division of an organization whereby the particular unit's manager is delegated the authority to accomplish the objectives or to work for attaining the goals of the organization. So along with authority, the manager also has the autonomy. That means to take decisions by himself. The top management of the organization or the enterprise, or those who are working at the corporate head office, they only supervise the manager's activities. Now here, when we looked at responsibility centers, 3 words became important. One is the delegation, second is the authority, the third is autonomy, thereby which a particular unit's manager or division's manager can take their own decisions so as to achieve the organization's objectives. Now, in the responsibility center, we saw an organization can be divided into various segments. Now, what happens if it is a single product organization or a small organization producing a single item? Then we say that it adopts a functional structure. What we mean by functional structure? Now, the various activities of the organization are segregated or divided according to the functional area for which they belong to. When we say functional area, they can be the production, they can be the finance, one can be marketing, one can be the R&D, etc. So each will be having a functional head, and each functional head will be reporting to the top management, or the top management will take the decisions how to operate or how the activities will go on. So here the functional managers, they only think about their respective functional areas for the single product. What happens as the organization grows, we may have multiple products. We may have products produced at different geological or geographical locations. So thereby, let us consider now that a organization is producing different unrelated products. Suppose a particular company is producing automobiles, it is also producing electronic goods like the mobile phones, computers, etc. So the company is into diversified products. So there a company may have a large number of diversified product items under its umbrella as it grows from a small organization into a big enterprise. So there the top management finds it difficult to control all the activities of the various diversified products under the umbrella of the organization. So there what the management tries to do, it tries to put a structure where the whole organization is segregated into various divisions or segments or small units which will be looking after a particular product. So each product will be having its own manager. Now the manager will be responsible for the activities of the department for which he or she is in charge, as well as he will try or she will try to achieve the organization's requirements, that is the goals. So when we are talking of this divisions, there can be divisions where activities relating to cost, revenues, profits as well as investment takes place, and accordingly the responsibility centers are named as. Now suppose we have an organization where a particular division is headed by a manager. The particular division, what it does, it only produces an item or it looks at the production department only, of the production. It does not looks after the sales or the revenue generation function. So here the manager's focus is particularly based on how to control the cost or the activities of the production which are related to cost can be minimized. So this particular segment we can call it as the cost center. Similarly, the items which are produced by the cost centers or the production department maybe will be handed over to the marketing department. Marketing department will be focusing only on how to sell those items, how to increase the sales, how to generate more revenue. So here the particular focus of the division or the manager's focus on of that particular division is how to generate the revenue, and so comes the revenue center. Now there are certain divisions which not only produce but also sell the items in the market or to its own sister concerns or other divisions of the parent organization. So there, the manager of that particular division will be responsible for the various cost activities and the revenue generation activities or the sales activities which are taking place in that particular division. So when we take revenue and cost at the same time, we know that we are talking of profits. So here the managers are responsible for the profit generation or the profit which will contribute towards achieving the organization's objective of maximizing profits. So whenever we talk of profit center, we talk of those centers, as we shall see in today's discussion of Unit 6, the profit centers, both activities of cost as well as revenue generation. Apart from that, the highest form of responsibility centers that we have is not only the generation of profit, but how assets can be built up in the divisions which will generate more amount of profits in the future years. That means the focus of the managers is not only the profits but also how to expand the organization's profit generation capacity in the future years by adding up what? Investment in various assets like machineries, land and building, equipments, etc. Today we shall be focusing on, that is our unit 6 of block 2, called as the profit centers. Now we have discussed about what are responsibility centers, along with what are the various forms of responsibility centers, cost centers, revenue centers, profit centers, and the investment center. Today we shall try to focus on the profit centers. Now let us see what is a profit center. Let us get ourselves introduced to the term, that is profit center. It is a responsibility center. When we talk of responsibility center, that means a particular manager will be in charge of its activities. So it is a responsibility center wherein the manager is responsible for both expenses and revenues. Manager is responsible means he has the autonomy to take decisions as well as is also accountable, and he has been delegated the authority by the top management for the particular responsibility center. Now the responsibility center is called as profit center because profit is the difference between the revenue and expenses. If revenue is higher than expenses, we say we have profits. If it is the other way around, that means revenue is lower than expenses, we are having losses. But managers take decisions with an intention of generating profits. That means how to generate more revenue, that means maximize the revenue and minimize the expenses so that the profit is maximized. The total performance of manager depends upon how decisions are taken on sources of supply and choice of markets. Now here we are saying managers are responsible for profits. They have been given or delegated the authority to take decisions. Now when they are given authority to take decisions, they have the autonomy to choose the sources of supply that means the inputs, and where they will be selling the outputs, that means the choice of markets. The financial performance of the particular division or the profit center is measured by the amount of profit achieved in a given period of time. Now here we try to say every investment center is a profit center, but not every profit center is an investment center. A particular profit center manager may use the already existing machineries, equipments, land and buildings, etc. for running the operations and producing the outputs which can be sold so that profits can be generated. Now these profits are contributed towards the organization's goals. Here they do not focus on adding on to the capacity or the long-term assets of the particular department, which would bring higher amount of profits in the future years. But when we are talking of investment center, we talk of activities whereby profits are utilized for establishing more assets in order to generate higher amount of profits in the future years. So we say profit center is different from investment center. So every investment center is a profit center, but the other way around, not every profit center is an investment center. Now it is different from the investment center as the manager does not have control over the fixed assets like machines and buildings. Managers are only given the existing machines and buildings in a profit center so as to utilize them in a proper manner and generate profits. Now if the manager has control over the fixed assets, that means it can add to it or delete to it. That means machines can be bought in, can be sold, buildings can be bought in, buildings can be sold. Then we say it becomes an investment center. Now let us look at corporate philosophy, style and profit center autonomy. Now when we are talking of the term autonomy, it refers to the freedom the manager has in decision making. The manager is given the decision making authority in terms of choosing the supply as well as choosing the markets where the items can be sold. Now here we can have two types of autonomies. One is intended autonomy, another is perceived autonomy. All of us know that in various kind of books, journals, or in various written forms, formulas, etc., there are certain guiding principles. Those are called as the theoretical practices. Now, in real actual field, all the theoretical knowledge may not hold good. So, it may deviate. So, there the particular person in charge has to be very practical in taking the decisions. So apart from the knowledge from the books, formulas, etc., they have to generate certain logics of their own. So autonomy can be of two types. One is intended autonomy, which is formally provided through structure, policies, and processes. In other words, just now we are talking about the theoretical aspects. But this always does not hold good. Perceived autonomy is what the manager actually uh, handles while carrying out or discharging his duties. So it actually exists as perceived by the manager. It is the practical aspect. Now this autonomy is influenced by corporate managers' involvement with profit center manager. On one hand, we say the profit center manager should have autonomy, or they should have the perceived autonomy. That means they should be practical in their decision making approach. However, due to their age old habits, corporate managers may have a what we can say inkling towards tampering with the divisions or the profit managers decisions. That means they try to get involved in the profit center manager's decision. So this autonomy can also be influenced by how much trust and confidence the corporate management has in the ability and experience of managers. So we can say the more the trust and confidence the management has on a particular manager or a particular uh, profit center manager, more is the autonomy that is provided to the particular manager. However, if the level of trust and confidence is somewhat lower, then the corporate manager may try to cut short the autonomy of the profit center managers. Now, when we are talking of profit centers, we are talking about the autonomy given to the profit center manager, autonomy for choosing the inputs as well as where to sell the outputs, that means the markets. Similarly, how much is the influence of the top management towards the decision making, as well as the ability of the manager as visualized by the top management. Now, this autonomy is coextensive with diversification. Now, let us see the two things. What is diversification and decentralization? The purpose of this particular diversification is utilization of resources to achieve maximum benefits. That means we try to divide the resources among various divisions so as to achieve maximum benefits from all the divisions. The percolation of profit responsibility from corporate level to divisions is called as profit decentralization. Suppose a particular corporate has decided the profit to be rupees 100. It has, suppose, four separate divisions which are producing diversified products. And looking at the past track records and the future um, economic conditions, the management decides that the particular centers, the profit centers A, B, C, D, the four, will contribute in the ratio of 20 is to 20 is to 20 is to 40. So what it means? The first three divisions A, B, C will have to generate a profit of 20 rupees, and the last division D will have to generate a profit of 40 rupees. Now this is the thing that is loaded by the corporate authorities to the divisional managers. What it is? Now it is percolating downwards from the top to bottom. We say the term as percolation effect. So thereby what is happening? Now the profit is getting decentralized. That means each division's profit level is assumed differently. Now, what are the various factors that influence diversification? When we look at the diversification aspect, uh, one can be product life cycles. We have many items whose product life cycles are from the time it gets introduced to the market till it reaches or falls from the maturity stage. That means it is going to be wiped out of the market, maybe a very short. Whereas for some product, it is very large. So, when we are looking at products which are having a very short lifespan, then we try to look at a diversified range of items to be produced. Because if one item is dying out, another item will be taking its place. Similarly, the end users. We know that end users are the customers or the consumers. Nowadays, we find the customers or the end users, their preference or consumption habits are changing at a very fast rate. So in order to adapt to their changing behavior, that means the end user, we have to diversify. Similarly, we can think about geographical locations. Now many items are there which are not available at all places. So corporates think that if I set up at various locations the particular unit's profit center or the division of profit center, then it may generate higher amount of profits. Similarly, the diversification is also influenced by mechanization. Nowadays we find use of more and more machines, robotics in manufacturing of items or creation of services. So we have to diversify from the labor oriented way of doing the activities to the machine oriented activities. Regulations. Sometimes you may find certain items produced has to face a lot of regulations. There, what we have to do? We have to diversify into other spheres. Similarly, competitors. We know that uh, certain products have very high competition. So there it may be difficult for the organization to generate profits. So what we shall do over there? We try to look at diversifying into such kind of products whereby the profit generation can be easier as competition is less in those kind of products. So these are some of the factors which influence diversification. Now, due to decentralization, what are the benefits we are going to get? Now, it is a better understanding of firm's objectives. We discussed about the firm, the top management's objectives, and in the last slide, we saw about suppose the profit to be generated by each of the division has to percolate down from the top management. So thereby what we mean, we take the firm's objective and we try to decentralize that objective into various divisions. So various divisions will clearly understand the firm's objectives and what they have to achieve. Second is better profit planning. Now, when organizations are decentralized, the divisional managers they strive to achieve or maximize the profits. So, they plan it in a better way so that the profit can be maximized. Third is the morale and motivation is, we can say, increased. Why? Now the manager has the authority and the autonomy. They will work in order to achieve for the objectives of the firm. Apart from that, they would like to perform their activities in such a way that they will be the leaders among the various segments. So this gives them the morale or the motivation to do their best. Better quality of decision making. Now in order to generate profits, decision has to be taken by the manager. When we decentralize, then the managers have the autonomy to take decisions. So they take the best decisions to achieve the objectives of their particular division, which in turn is achieving the firm's objectives. This allows top management on strategic aspects. Now, if an organization is decentralized and the decision making is given to the various divisions regarding the profit generation, then the management now do not have to worry about that part, because divisional managers or the profit center managers are there to think about it. The top management will now think of other strategic aspects, like in which way they can have more investment for their enterprise. Another benefit of decentralization is it is the training of future managers. Now what happens when the divisional manager or the profit center manager has the autonomy of taking decisions? They may have various subordinate managers working under them, and they will also be uh, giving them some kind of decision making authorities. But however, you have to keep in mind the responsibility and the accountability lies in the profit centers managers head. So when the profit center manager allows the younger managers to work or take decisions in order to carry out some activities, the lower level managers get trained in the better decision making practices. Another important benefit of decentralization is it encourages spirit of competition. Now, when we have the different divisions of the organization as profit center, it generates a competitive spirit or motivates the manager that how their particular division will be the best among all the divisions of the enterprise. When we say the best, it is in terms of the profits. Now, what are the various limitations of decentralization? It is a costly form of organization. Why do we say that? Now, when we decentralize, the record keepings are done at the divisional level or the profit centers. However, this is also duplicated at the head office level. So thereby we find multiplicity of recording and storage of those transactions or informations at various levels of organization, which will prove to be more costly. Necessary restraint is difficult. What is this restraint? Now suppose the top management or managers at the top level have a habit of entering into the domain of the profit managers area or a particular divisional managers area. Due to this habit, it becomes restraining them from curtailing the autonomy of the profit center managers. You say it becomes difficult. Now there can be frictions and dysfunctionality among divisions. How? Now not all the divisions will be making profits in an organization. Some divisions may also be making losses. What happens? The losses of a division may be offset by profits of a division when we look at the organization as a whole. So the profit center which is generating profits will have a friction with this non-profit generating divisions due to their we can say bad performance or dysfunctionality. Sometimes what happens, the output of a particular division becomes the input of a input of another division of the same organization. Now here the question mark arises, since both of the profit centers or the divisions are belonging to the same organization, what should be the price that should be set for transferring the items? Now obviously the division or the profit center which is taking the output of the other division will want it at somewhat lower price as compared to the market prices. However, the division which is producing these items will say that no, we cannot give it to you at that price. We may able to maximize our profits if we sell it in the market. So there the conflict of pricing arises, which is called a reserve by transfer pricing, which is usually done by arm's length pricing. What is that arm's length pricing? Now, if the division of the profit center which is producing the item to be used as input by another division or profit center, the price of the item should be set in such a way that it should be equal to the market prices under similar conditions, under similar economic influences, etc. Another limitation is the difficulties in allocation of common cost. Now there are many other departments which provide services to the various profit centers, like we can say legal services, sorry, we can say accounting department, etc. Now, how can we divide their cost among various departments? The profit centers may say that since they belong to the head office, their services or the costs are free to us. No, they have to be charged. Another limitation of decentralization is unhealthy competition. Now suppose two divisions of an enterprise are selling same kind of products in same kind of market, in a similar market. There, the two divisions may be at loggerheads in the marketplace. That means they will be fighting it out as competitors, which may lead to unhealthy competition practices. So this can be a limitation of decentralization. So how decentralization can be successful? There should be minimum interdependence. That means each profit center or division generating profit should be having as less as possible dependence on other divisions. There should be as little direct competition in outside market among various divisions of the same organization. The manager should have the operational autonomy. That means the decision making capacity of the manager of profit centers should be based on their own choices of getting the inputs from suppliers or the markets where they will be selling their outputs. Another is there should be a feasible, rational, acceptable transfer pricing. Usually the arm's length price is used. We have seen that many a times top management, they try to enter into the domain of the profit center manager's decision making area because of their old habits. So this should be done away with. There should be non-interference policy. We have also seen the profit centers. They always focus on the short-term profit, because what happens? The managers who are heading the profit centers, they may think, or usually think, it has been seen, that uh, if they show higher profits during their period of stay in the organization, they may be rewarded in a better way. However, this may prove detrimental to the organization efforts. In the long run, the organization may suffer. So, the profit managers should not only think about the profit of their divisions, be it short, be it long time periods, but also they will think about how long term profitability can be achieved. That means profits not only in this short time span but also over the years. Now, in order to establish profit center, the things that we require are operational independence. That means each division should be independent of each other in their own activities. The profit centers should have their choices to access the sources as well as the markets where they can sell the items. Now, the profit center should be based on those divisions where the costs and revenues can be shown separately. The management also should have a proper intention towards establishing profit centers and should delegate the authority to the profit center managers and focus or channelize their work towards the strategic aspects. Now, profit center should have prevalence in generating profit, and it should have motivational values. Motivational values, that means motivating the division managers, the divisional employees as a whole, which should percolate down from the corporate. Now, types of profit centers. In general, we have two types of profit center. One is genuine profit center, another is artificial profit center. What is a genuine profit center? Now here the manager has enough influence or control on activities of the division. The activities are separable into cost and revenue activities, and which are undertaken according to the manager's decision making of that particular profit center. Sometimes what happens, there are certain items which according to manager's decision, the profit center manager may or may not have enough influence or control on activities. Usually these are functional units. The service and the support as well as the manufacturing. Now, how can we measure the performance of profit centers? Now what we have done here is we have taken the master budget of a particular company, that is ABC Sports. In master budgets, we have taken the revenue, that is sales, and expense, that is cost. So immediately we can say that it is a profit center data for a particular period 1. ABC Sports produces two type of products. For the period 1, it has budgeted that it should produce the tennis balls 400 units and footballs 600 units, and tennis ball per unit can be sold at 10 rupees, football at 40. Thereby tennis ball will generate a revenue of 4,000 and football of 24,000. The variable cost for manufacturing and marketing turns out to be, for tennis balls it is 6, a total variable cost of 6 with a total of 2,400, whereas for football it is 23 at 13,800, so total of 16,200. When we are talking of contribution, it is the difference between the revenue and the total variable cost. We can say revenue minus total variable cost is the contribution. So per unit contribution for tennis is 4, and for football it is 40 minus 23, that is 17. Thereby the master budget is saying for 1000 units of tennis as well as football in 400 and 600 units each, the total contribution is 11,800. Now when we take out the total contribution from the total revenue, that is 28,000 minus 11,800, yes, we have got the revenue. We have got revenue minus variable cost, it is contribution. Yes, fixed cost is also given. Overall fixed cost for period 1 is 6,800. That means if you produce or do not produce, then you have to pay 6,800. The profit is calculated as contribution minus fixed cost, that is 11,800 minus 6,800, giving us a budgeted or a master budget figure of 5,000 rupees. Now let us see actually what has happened during the period. Here actually we have sold 500 units of the tennis balls. In the budget it was 400, I presume, and here it was 600. Similarly, revenue, if we look at, was 10 rupees and 40 rupees. This was 10, this was 40. And fixed cost also has changed, and we get a net profit of actual 3,000. That means it has come down by 2,000 rupees, because we had 5,000 as budget minus 3,000 as actual. That gives us rupees 2,000, which has come down. That means unfavorable. We say negative or coming down is unfavorable. Now we have the budgeted figure and we have the actual figures also. Now why this 2,000 loss we are finding? Now we prepare a flexible budget of ABC Limited. Now this is based on the actual units and the budgeted prices. Now if you look at The tennis, we take the actual unit sold and budgeted sales price, total comes to 25,000. Similarly, the variable expenses for tennis was 3,000, for football it was 11,500. So total variable cost was 14,500. Now we shall calculate the various variances as we have done for the cost center. If you remember, in those particular unit, we calculated total cost variance, we calculated total cost variance comprised of the price variance, uh, and the expenses, the price as well as the expenses variance. Similarly, here also we try to analyze the variances. Now look at the figures. These are the figures that we have got from our data set. I have master budget, I have flexible budget, I have also the actual budget. So volume mix, that means the variance due to the volume or the change in volume will be calculated as 2 minus 1, flexible minus master. Similarly, the change in prices will be calculated as 3 minus 2. Now let us see the total sales. The volume mix is here 25,000 minus 28,000. That gives me rupees 3,000 unfavorable. Similarly, expense variance if I take, then 24,500 minus 25,000. So I get 500 unfavorable. What it means? Unfavorable means negative. Now look at the various variable expenses. Similarly, we can go on calculating the first one, volume variance 9,500 minus 10,600. That gives me a figure of 1100 unfavorable, and this is 500 unfavorable. Now here we have 600 unfavorable, here we have 0, here we have 1700 unfavorable. If you add these two also, this gives you 1700. This is 500 unfavorable. Now look at the contribution part. Sales minus variable cost will be giving me the contribution 11,000. This is 300 unfavorable. This is 1,000 unfavorable. So and here we find the net profit before tax 300 unfavorable, and this is 1,700 unfavorable. If you look at this, so we know contribution minus fixed expenses, contribution minus fixed expenses, volume mix, and the expense. If we look at this and we combine these two, I presume the profit is down by 2,000 unfavorable that we had seen in the initial slide, which is due to 300 rupees due to change in volume and 1,700 due to change in prices. We saw in the previous slides, yes, the change in units sold as well as the change in price has some kind of impacts. So the volume and expenses together, they give you 2,000, the change in profits. So mainly the prices are affecting much as compared to the volume. Now here we try to see what is the sales mix percentage. In the budgeted case, it was 40:60, 40%, 60%, but actually it was 50, and it was also 50% for the football. Now you can calculate the price and expenses variance as we have done in the previous slide here. So the variances will tell us, as we see here, the volume, due to expense, how much we are having the impact. Similarly, here we see what is the impact due to change in sales mix. Now, finally, what are the problems in reporting? We have two types of problems. We have revenue difficulties, we have expense difficulties. So revenue difficulties, transfer pricing is one of the biggest aspect. When we talk of expense, the machineries might have been brought some other period back, but how much is the cost now to be included? So this is all about the sales or the cost part for a responsibility center taken together to form the profit center. How we can set up one profit center, how we can calculate the variances, and what are the influences which has created the various variances. So this is all we have for the discussion. Thank you.